What's good, everyone? Thanks for stopping into the Built by Bailey's YouTube channel. I wanted to put out a video talking about the big looming questions in 2021, and that is real estate and the stock market going to crash? And should you take advantage of selling your home in 2021 if you have massive equity and capitalize on those gains that you've earned over the years? Let's get into it. All right, before we get started on all these big questions and the loom and doom of 2021, possibly, if this is your first time stopping by, please consider hitting that subscribe button and the bell for notifications for future videos. I put out videos every Monday and Friday afternoon in the world of home building and real estate investing and all the fun stuff that comes with it. I believe in getting all this information and these skills that I teach out to as many people as possible. The general public needs to get this information, especially as we move forward and return to normal life. These are very important things that I believe people should have in their pocket. And the more people that subscribe to this channel and hit that like button, don't forget, please do that, the more this video and others like it will get out to the general public and spread the word. I believe in teaching you guys as much as I can, and the more help I can get from you guys by hitting that subscribe button and the like, and obviously spreading the word on this channel, the more people get out and get this information. It is free 99, so please help me out by doing that. Also, you can also check out our Built by Bailey's podcast, which talks about all of these different topics. We have great guests that come on in the world of entrepreneurship, running businesses, building homes, investing in real estate, how to become a real estate agent, all these kinds of, we have amazing guests. Those can be found here on the YouTube channel itself. You can also find our podcast on Apple, Spotify, Google, Vurbl, and Podbean. So make sure you check that out. All right, let's get right into what is going to happen with these markets and should you sell your house in 2021. Okay, so just recently on March 4th, Jerome Powell, who is the Fed chair, came out in a meeting and started discussing some of these topics, and more people were kind of hoping he'd give us more information, including myself, on what is actually going to happen as we start pushing forward back to normal markets, life, so forth, and the reopening of these economies in a full spectrum as we're kind of getting closer. We are getting closer to this, so we want to kind of pay attention to what's happening, all right? The biggest thing that we want to talk about really is that the expectations of market year over year. So let's talk about sentiment of people in the market, people watching the markets, and that's both real estate and Wall Street, and understand kind of what's going to affect us as we move forward and make our decisions a little bit easier, hopefully, as we get into these topics and kind of watch what's really going to happen. The biggest thing to understand is that inflation has been declining for decades, as opposed to what's supposed to happen in most markets. Decades of declining inflation has led to the sentiment that as technology increases to make our life supposedly easier, that things are supposed to get cheaper. And that's something that's going to really affect us as we move through 2021 and into the future. The other thing we want to look at is the CPI, or the Consumer Price Index, and that's an overall sentiment of market showing us what's happening in relation to inflation as we move through year to year, especially coming out of a pandemic. And the thing we want to pay attention to with the CPI from 2020 to 2021 is you're going to see a sharp increase. And the reason being is things shut down. Everything stopped literally abruptly and without warning to most of us, right? So we have to pay attention to the fact that that's going to kind of lean us in a unrealistic perspective what's really going to happen as we get into 2021. So saying that, as CPI shows that sharp increase from this year compared to last year, it's going to look like inflation. It's going to look like a sharp increase in inflation, and that's not realistic. And that's kind of what Jerome Powell was talking about last week on March 4th during that Fed meeting, with Powell saying that this is not actual inflation and that we actually need to be at a sustained mark, which I'll talk about in a minute. What's happening and what happened on March 4th with that drastic decline in the overall stock market was the fact that Powell is saying we're not seeing any of this inflation yet. And at the same time, the Fed is continuing to print money. They're just running that printer and throwing money out over and over again. And Wall Street's not believing what's coming out of Powell's mouth because of that sentiment that he's talking about based on what his actions are showing to us. Powell did say that real inflation can actually spike once we have a full reopening of the economy. Again, as we push forward closer to a more normal way of living again, numbers change with the virus. He is saying we're going to see a spike potentially as we reopen completely, but that's only going to be temporary. And again, like I'm saying, the market's not listening to what Powell's saying. They're actually betting against him because of the fact that as he's saying these things, they're in there running that money printer. And that's exactly what happened on March 4th of that huge drop in the market. The one thing that I did kind of pay attention to that Jerome Powell said was that Powell overall is not concerned yet with any of the economy as it's moving back towards reopening, because we haven't had, as he puts it, a good baseline yet of a minimum of 6 months once we reopen. He's looking more at an 18-month time frame to determine what's happening with the real economy and the economy and the market, which are different, but what's happening with both of those as we progress back to normal life. And the other thing I wanted to note from that was that he did say that he's not concerned with any of this unless the banks start freezing credit. So with that being said, as Powell is saying, he doesn't foresee rates going up at any sort of recent time. So he does think that rates will move, but it's going to take quite a while. He needs to see substantial growth, substantial progress for some time, which are his words. And he was, again, saying that's a 6 to 18 month timeline minimum before we can actually project what's going to happen and when and if he's going to bump those rates. And again, he said there hasn't been any progress at all yet, and there's no recovery yet. We're not even fully open yet. We're not back to normal yet. So there's no projections that he can give at this time. Okay, the things that Powell needs to see once we're fully open is a sustainable max employment, and that's not just a standard 4% unemployment rate that we tend to kind of base numbers off of. That's max employment for all genders, all races. He needs to see that for sure. He also stated that we need to be at a substantial 2% inflation goal as they've been looking at, and that's kind of their earmark as we move forward. That's important to watch. Inflation expectations are assumed to be transitory or temporary, and at some point assumed to actually retrace. So keep that in mind. And again, Powell is saying he needs to see substantial growth and we're only at some sort of progress right now. It's very minimal, and there's no way there's any projection that's going to happen. So as far as increasing interest rates, that's not going to happen. That's something to kind of keep an eye on, again, as we look at market movements and the potential to sell your home because of those rates and what's going to happen with the buyer and seller markets if you're thinking about selling. The other thing we want to pay attention to as we get to an expiration or a deadline is the supplementary leverage ratio. Now, what is the supplementary leverage ratio? So the SLR, or the supplementary leverage ratio, was eliminated during the pandemic last March. Okay, so it's been about a year that they've actually eliminated this SLR, which basically what it does is allows banks to forego that requirement to allow them to lend more money. Obviously, as we're looking at that, reason behind that was to open up the books on more banks to go help the people that were struggling during the shutdown period, during the pandemic when we were at the worst for lockdowns across this country. For businesses, for individuals, that's kind of where some of this money's been coming from, is allowing them to kind of move it. The Fed prints to go ahead and help as far as stimulus. The banks can help businesses. They can help landlords, etc., by being able to forego the SLR and get in to free up more money to go and lend out to all these different groups. Okay, so something to keep in mind with the SLR. Okay, it's a tier 1 leverage ratio. And what this really is banks calculate the amount of common equity capital they must hold relative to their total leverage exposure. So large banks need to hold 3% is kind of their earmark. Top tier banks have to hold an additional 2%. So a 5% total reserve on that is what they're required to do. And really what it is just a backstop to risk-weighted capital regulations. And again, like I said, it allows banks to exclude U.S. Treasury securities and deposits at the Federal Reserve Bank and from a measure of capital relative to their assets. All right, so it's meant to free up assets, like I said just a minute ago, to be able to allow the banks to make more loans during this really, really tough period. Now, I did mention what's Tier 1 capital, and the Tier 1 capital is basically the core capital of a bank, and it's the primary funding source of the bank itself. So that's really what shareholders' equity is and retained earnings. Tier 2 then would be the reevaluation of reserves, hybrid capital, subordinate term debt, loan loss reserves, and then like undisclosed reserves as well. So the SLR is coming due at the end of March 31st to be exact. And we got to keep an eye on that to see if Fed Chair Powell is going to actually extend that again. And if he doesn't, what is that really going to mean for these markets as far as the lending goes? And what does that mean for the real estate market in particular? Okay, so interest rates and inflation are two things we want to keep an eye on as we progress through 2021 to help us kind of get a really good gauge as to what's going on in both the real estate and stock market, and then have a better understanding of where our money should be and if we should actually take advantage, like I said, of that massive equity that a lot of people have actually built up in their homes. And if they do decide to sell their home and they get that equity out, what do you do with it? So I wanted to go back and pinpoint a couple pieces of time and pieces of history and look at the inflation and what that really means to us as the dollar relates to reopening the market, etc. So I've basically taken a little snapshot of the year 1938, which was a recessionary period towards the end of the Great Depression. And I wanted to kind of compare some numbers from then into today. And you can kind of see how inflation can be dictated and how our expectations of inflation tend to be kind of the opposite of what they should be doing from year to year. And it's really important to kind of understand these numbers to make a better decision as to, one, is the market really going to crash on us? And two, if so, should I sell my house? And even if it's not going to crash, am I at a good point now where I can take that equity, move it somewhere else, and what the heck do I do with that money, Shane? Okay, so 1938 cost of living statistics. The average cost of a new home in 1938 was $3,900. Okay, we'll get to these numbers here in a second to understand really how do you compare these. Average income in 1938 was $1,731 per year. The average price of a new car was $860. Average rent per month was $27 per month. And then the average cost of gasoline was 10 cents a gallon. Okay, I'm kind of going to just scream through the rest of these numbers because I want to compare those to the year 2020 and to kind of give you some breakdowns of how you can relate these numbers and really what that means. So let's talk about the same numbers in 2020, all right? 2020 saw the highest average home, or actually median price of home for a new home in this country. That was $334,000, okay? Average income per household in 2020 was $87,864. The average price of a new car last year was $40,000. And then we want to look at rent and gas prices. So rent, the average cost of a one bedroom in this country last year was $1,690. And for a three bedroom, that rent was $2,017, all right? Gas price across the country last year averaged $2.17 per gallon. That's actually 44 cents lower, or 17% lower than the previous year, 2019. Something to kind of keep in mind as we're looking at some of these other numbers and watching market conditions, okay? So comparing those things between home prices in 1938 and income in 1938 compared to last year, all right? Let's kind of get an idea of what's going on here. So $144.25 a month was the average income in 1938. That's just basically 1731 divided by 12. All right. So with a home price of $3,900, that average wage had to account for 44% to pay for a house. Basically, 44% of your income went to buy a home in 1938. As compared to 2020 last year, it was only 26% of your income going to the cost of that new home. All right. And the other thing you want to keep in mind in 1938 is their peak unemployment of 19% during that recessionary period. And again, we're coming out of the Great Depression, but there's a recessionary period that happened during that time. And really, the Great Depression lasted into the early 40s, if you want to look at real numbers. So keep that in mind. Okay, so now that we've kind of wrapped our heads around kind of movement in the market, what's going on, what happened last year, how does that affect us this year, what am I looking at moving forward, and kind of the other elephant in the room is I've got a lot of equity in my house, Shane. Do I sell it this year, and should I sell it earlier than later? So let's take a look at what that's going to be and then decide how much equity is enough equity where you should sell your home. And then with all that cash coming to you, especially because unless it's over those certain thresholds for a single or joint, filing jointly as a married couple, as far as your capital gains, you're not even taxed on most of that money, if any at all. So what do you do with that money? So in order to be able to decipher what you're going to do with your home and what you should be investing in 2021, let's kind of take a pros and cons approach to stock market investing versus real estate investing to kind of help you get a better grasp on your decision at this point. Something to keep in mind was there was a time in history in this country and across the world too, that you spent your entire life working to pay off one home. That is not the case anymore. In fact, the average couple or the average household stays in their home 3 to 5 years before they sell it and move to something else. No one's living in their home for 30 plus years and paying off an original mortgage or a refi. People are moving more often now because of the fact that we have appreciable value in real estate and it grows more rapidly now than it ever did. So people are taking advantage of that. They're making their money in their home, which is why real estate is so great. And they're taking that capital to go buy a nicer home, a bigger home, a newer home, whatever, because now you have capital to put down and keep that cost of living down as well because of that down payment from the equity made in your other home. Okay, so that being said, should you invest in the stock market or real estate? What do you do with your money at this point? One of the pros of investing in the stock market is you literally need like $1 to start investing in the stock market. With real estate, you usually, most times, need a pretty substantial savings for most people in order to buy a home because you have to have a down payment. Even if that down payment is 3 to 5% on an FHA or similar program, it's still a lot of money to most people, especially if we're looking at a median home price last year of $334,000. It's a lot of money to a lot of people. Real estate transaction fees can be high, those being appraisal fees, bank fees, closing fees, document prep fees, all the title fees you have to have, origination fees on the loan. There's a lot of money that you have to actually bring to the table. You have to have some sort of cash available in order to buy and purchase investing in real estate. One of the other things to think about with real estate that's a pro though is that real estate is tangible, meaning you can actually touch it, feel it, live in it, obviously. Everyone needs a roof. Everyone needs somewhere to live. So as far as on the investment side, buying real estate to lease and rent out to people that need somewhere to live is an investment. You're having someone else pay your mortgage, which is a good thing to have because at the same time, that real estate purchased properly is going to grow over time. So someone's paying your overhead for you, and at the same time, you're growing that asset. It's making money for you. So that's another really good benefit of owning real estate. You have deductions you can take on your investment or your primary residence as well, the mortgage interest deduction and other ones that you should go and learn and read about. Those are all deductions that will help you keep those costs down, especially on the income side, as you let your asset grow in real estate. On the other side, if you're investing in the stock market, there is potentially more risk to be involved investing in stocks and options. Keep that in mind. You're also subjected to capital gains test on any money that you make on your stocks and your gains on those investments. The other risky part of the stock market is it can be affected more by emotion. News can drive a change in a stock or a contract on an option, and you have to be wary of that. You have to be more involved in it even than in a real estate transaction where you have an investment that a lot of times, if it's an investment, can be run by a property manager. So you're more indirectly involved in it than you would be in the stock market. You got to be careful of that emotion because, as a lot of people have seen, especially with the GameStop and AMC stuff that's happening with all the news that you saw there, there is a drive on emotion and more influence that can be adversely affecting you that you have to be paying attention to. So you have to understand more about what you're putting your money into when it comes to the stock market. And with that being said, real estate is not as volatile as the stock market because of that same emotion and news-driven kind of criteria. However, if you're looking for bigger gains, you can grow those in the stock market because of that same volatility, where with real estate not being as volatile, those gains are going to happen more slowly. So it's more of a patience play or a patience play. Okay, I've thrown a bunch of information at you. Most of it's probably confusing, and I would actually recommend, if something or one part of this was actually confusing, go back and watch it again. If you've got more questions, please leave them in the comments below. I will certainly answer them as soon as I can get to them. But let's kind of wrap this thing up and decide what's going to happen with the market in 2021. And dude, should I sell my house or not? Right? Okay, first and foremost, do I foresee a stock market crash in 2021? No, I don't foresee a crash. I see some retracement happening market to market, indice to indice. I do have some concerns overall. I'm not going to get into those because I promised I wouldn't do any tinfoil kind of discussions outside of just really market conditions and economic statistics and data. I'm not going to get into my tinfoil. I'd love to, but I'm going to leave that out on this video. I don't foresee a huge crash. That's just my opinion. It's not financial advice. And again, if you're involved in investing in the stock market, stay with stuff that you know, that you use, that you trust. Do not run off of volatile news that's popping up on Reddit or at Twitter or anywhere else. Be informed, understand what you're getting into, and understand your place. Don't put all your money into any one thing. And that being said, when I'm talking about selling your home in 2021, here's what you can consider. If you do have massive equity in your home, I actually would recommend selling your house. Capitalize on that money because none of that is real, whether it's a stock that's run up a bunch and you have what you've seen is short-term gains, or you have an investment in your real estate portfolio that's gained a lot of equity over the years, and it's now worth a heck of a lot more than it was when you bought it. Those aren't realized gains until you actually sell that asset, right? Whether it be a stock or real estate. So until you sell that back to the market, that number means nothing. If you've got massive gains in your real estate portfolio somewhere, I actually, and I have done this myself, use those gains for other things. I would say if you're looking to do that, you can take some of that money and push it back into the stock market. But I always, always, always preach diversity in everything, and that includes investments too. If you're looking to do that, put some of that money into long-term stocks, big companies, blue chip, information, stuff that's been around and not going anywhere. If you want to have a little bit of fun money, that's up to you. I'm not going to recommend doing any of that. You certainly can, and you can certainly make money in the market doing that. I have as well. But as far as putting all of your eggs in one basket, don't ever do that. So if you're going to sell your house, I actually can see that making sense, and I actually would say that's a good idea if you've got massive gains. I'm talking about $200,000 to $300,000 of equity in your home, or if you're in a place where you're hurting right now, and a lot of people are still, and it's going to take a lot of time to recover, you can actually use some of that to pay some debt off. Just make sure that you have cash available and don't go more than 50% out of cash anytime at this point. Again, not financial advice, but that's something that I always do for me, and that's something I do with my business partners and recommend to others, making sure that you have cash. It's always going to be a king, okay? Taking some of that into the stock market's fine, and selling your home is fine if you have some sort of ratio in that realm. Okay, that being said, do you take some of that money and reinvest it in real estate? If you can find good deals and they're out there, I certainly recommend rolling some of that back into real estate, especially if you're going to get hit with capital gains tax. You can do that 1031 exchange. Now, make sure you're up to date on the tax limits for equity. So capital gains tax on real estate and that $250,000, $500,000 limit ratios. Make sure you understand those. Anything underneath those thresholds, you're not paying any capital gains tax on. But if it's an investment property, you're going to pay capital gains on it. So make sure if you do that, you're going to either be able to pay the capital gains or you're rolling it into something else through a 1031 on another investment property. There are deals out there to be found, and I'm definitely bullish in real estate still this year. Keep that in mind. Now, the other thing you want to understand too is people have this misnomer where if they sell their primary residence, they need to go and take that money, at least some of it, for a down payment, and they have to go buy another home to live in. You don't necessarily have to own a primary residence to be involved in real estate. You could actually go rent something for your primary residence, and then you could go off and you could use some of that money to buy investment properties. Investing in real estate and being involved in the real estate market doesn't necessarily mean you have to own your primary residence. Keep that in mind. Something I've done in the past, something I'm doing moving forward. At some point, it's good to have your primary residence under your belt, under your actual investment belt, but you don't have to have that in the short term. You can certainly rent short term. I see no problem doing that as long as you're getting some of your portfolio in the real estate game on some level. That's totally fine. Keep that in mind. Short-term rentals on primaries, not a big deal. There's no rush to get right back into a primary residence as far as ownership, especially with a little bit of uncertainty as we move into the second quarter of the year. What's going to happen with rates? What's going to happen with the real estate market, etc. So, overall sentiment, I'm still bullish in real estate. I still think if you've got a ton of equity in your home, I have no problem with you taking advantage of that and capitalizing. Cash out now. Go sit on it for a little bit if you want to, rent something, put some of that back in the stock market. But as far as overall crash, I'm not super concerned. I don't see any sort of lean way towards any of those things starting to happen. But as I talked about at the beginning of the video, those are kind of our core elements we're looking for, and we want to watch as we move forward in the second quarter and the rest of the year. That's it for this one. I hope this helps you guys kind of decide which way you want to go as far as investments, as far as selling your home, and maybe calm me down a little bit about an overall market crash. Keep watching. I'm going to have more videos coming out on this topic as well. I'm going to be watching it obviously as we move forward. And if you got questions, again, go ahead, leave those comments in the description below. On your way out, if you haven't already, hit that like button. I really appreciate it. Please consider subscribing. It really helps me get this channel and grow it as rapidly as possible. I want everyone to have this information. I want everyone to have these tools to help you earn your own wealth. So until next time, guys, I really appreciate it. See ya. Yo, step to my click and get overrun. The weight on my shoulder feels like a ton. This is all I want, fuck a one-on-one. This termination, no vacation. Vibration, create a creation that has nothing to do with religion. It's all part of an intricacy.